Never tell them that Nifty is going to touch 18,000. Technical analysis is a way bigger subject than just learning few candlestick patterns or few volume patterns. Our relationship with the money remains the same as it was in 1950, as it was in 2000, and as it is in 2025. People are using this theory in a very incorrect way. And if you can understand these six tenets properly, then believe me, my friend, 90% of your job is done. The indicators are just waste of time. Hello and very welcome to this new series of your CMT preparation. So my name is Bharat Jhunjhunwala and I am a chartered market technician. I have also done CFT. I am also qualified MSTA, and I have also written a paper for IFTA magazine that was published in their magazine, and I have been rewarded MFTA for my research on a technical indicator that is known as B extender. So I've been trading since last 17-18 years, very actively trading since last 17-18 years, and I follow most of the time I follow price action and I follow RSI and other indicators that are not the external indicators, whether they are internal indicators like the market breadth or the intermarket analysis and cross market analysis or cross assets analysis. So that helps me in timing the market even much better way than any other tool that anyone else uses. So I've been getting a lot of requests for starting a program or starting a curriculum for teaching CMT curriculum. So with that request, I have decided to come up with a series where I will cover the CMT curriculum. The CMT Level I curriculum will be covered, and gradually we will move to Level 2, Level 3 after completing Level 1. So in this series, I have covered the whole CMT Level 1 curriculum, and it has been covered in a very exhaustive way. So we have covered the whole CMT Level 1 chapter wise. We will go chapter wise, we will go topic wise, and we will do the theoretical part. We will use the PowerPoint for it, and then we will show everything that that we are learning in the theory part on the charts as well. So you will be also be able to learn all the things and on the charts as well. So you will be very much familiar with how the theory turns into practical and how you have to use those learnings that you have read in the books. And along with it, we will also provide you a question bank with all the multiple type of questions that can come in your examination. So we have prepared like a lot of questions as well. So you will be able to download them from our website once you watch this program, and then you go. We'll provide the link in the description for you to go across and download those curriculum from the website as well. Right. So with that, let us start the first class today, and I'll keep it light. And the first topic and the first section more or less focuses on what technical analysis is, what is the philosophy of technical analysis, what is the trend, what is the support, what is the resistance, and how we should approach technical analysis, the pros and the cons of technical analysis. So it's not very much heavy, it's a light chapter, and we have also tried to keep it as light as possible. So let us start with it. So first is introduction. To what introduction is? Technical analysis is basically when we study a security. The security can be stock, it can be a commodity, it can be a crypto, it can be a forex, whatever it is. When we study the security through price action, volume, then we are talking about technical analysis. When we talk about price, when we talk about volumes, when we talk about candles, when we talk about bars, we are talking about technical analysis. And also advanced study of these derivatives can be done by open interest. When we will cover derivatives, then we will cover open interest as well. But the thing is this, that technical analysis is basically the study of price, volume and open interest. So when we are talking about technical analysis, we are more concerned about price, volume and open interest. But believe me, the scope of technical analysis is beyond this. Technical analysis is a way bigger subject than just learning few candlestick patterns or few volume patterns. This won't help you to become a successful trader. You need to widen your ambit to learn more of technical analysis. So it focuses on what is happening right now. It is not focused on why the things are happening. So if there is a strong movement of a price, We are focused on what is happening right now. The price has moved strongly up. What you have to do now, whether you have to trade it, whether you have to wait for it, whether you have to exit if you are into a counter trend position, whatever it is. So you are more focused on what you have to do with the event that has taken place, what you have to do with the price action that has taken place, the price action that has unfolded. Now you are not concerned about why this is happening, why the price opened gapped up 10%, what was the real news behind it. You are not concerned about that, right? That is a different subject altogether. So we are more focused on what is happening in the price and what you have to do with that information that is in front of you. All right, why it is happening, who bought, who sold, that is none of our matter, okay, as a technical analyst. But I can assure you that this is just what we are covering academically, but in real life everything matters. So we will cover it as we go ahead. Technical analysis has a basic philosophy that everything, all events that have taken place or all event that may take place has already priced in, right, already discounted. The price knows everything that has gone by or that may come ahead. So sometimes you may see that the momentum when you are doing a momentum study, when you are doing some sort of analysis on RSI, you will often see that divergence occurs, right? So if the divergence is occurring, we know that the momentum is getting weakened, and then some sort of event occurs with the stock or with the price, and the price starts to fall down in case of bearish divergence. So the price has already accounted for the event by the divergence that we have seen. So this means that everything that you hear, everything that you see, everything that you read has been already discounted in the price. So suppose an overnight event take place, right, where you see that somewhere the war has broken out, or somewhere some geopolitical issues have been erupted. But when you will go on the chart and when you will analyze those things on the chart, you will see that has been already discounted in. The crude prices were already up. The gold was already up before this event even took place. So there was something that was already discounting, right? The event was already been discounted in the price. So it's very, very important to understand that all the events that are going to happen will be there on your charts before it happens, before the public comes to know about it. Okay? Because when an event happens, everybody is reading about it, everybody is listening to it, everybody is looking at it. As a chartist, you have to go to the charts and try to figure out that something is wrong or something is unusual in the chart, right? That may trigger some event XYZ. You don't know about the event, what event will be triggered, but that may trigger some event going ahead. So this is what technical analysis is all about. It says that whatever information that is available publicly has already been discounted in the price. So we have to study price very, very closely to understand the impact of the event, right? And again, it seeks to identify price trend and reversal points. So by price action study, when we are studying price action, when we are doing momentum analysis, what we are focused on? We are focused on price trends, because how we will trade when there is a trend? Without identifying a trend, we cannot trade. Suppose we have identified a trend, and now how we know that this trend is going to reverse, and how we will know that we have to exit? That will be defining the reversal points. So as a technical analysis, we seek to identify the trend of the price and the reversal point of the price. And how we will do it? We are looking for patterns. We are looking for setups that appear on the charts, which tells us that a probable event may happen. Now these patterns are formed because of investor behavior. Now see, everything changes over the time. Like when the BSE started, it started beneath a tree. The Bombay Stock Exchange was started beneath a tree. And then we saw slowly things evolving. We saw people shouting in the ring. We saw picking up the phone and calling the broker and placing the order. Now probably we know that the order can be placed easily on your phone within a fraction of a second. Now algos have come. Even you don't have to interfere to punch your orders. Robots are doing it. And the technology may so evolve that it may go at a point where you think and you can place your order. Everything is possible, right? Nothing is impossible. So everything has evolved, but one thing has remained same, that is the behavior. We think about money in the same way throughout the globe, whether you are placed in South Africa, whether you are placed in America, whether you are placed in US, whether you are placed in UK, whether you are placed in India. Our relationship with the money remains the same as it was in 1950, as it was in 2000, and as it is in 2025. We think about the money in the same way. So, if we think about the money in the same way, we will behave in the same way when some event trigger. So, suppose when a war breaks out, we will behave in the same way as we have behaved in the year 2000, in the year 1999, in the year 1995. We will behave in the same way. There will be panic. We will rush to book our profits, right? So, the investor behavior, the participant behavior remains the same. Just the times have changed, just the events have changed, right? So, history will repeat itself, but it will not repeat itself with the same reason, but the reaction will be same. So, this is the basis of technical analysis, that the investor behavior, that the investor reaction to a certain event doesn't change. And because of this behavior, we are able to trade, we are able to figure out patterns, we are able to put the trades. And this is the core of technical analysis that we have to understand. Okay, so I think that we are getting it. So, the foundation of technical analysis, we all know that Charles Dow started plotting the charts. He started using technical analysis. He created the Dow Jones Industrial Average. He created the Dow Jones Transport Index, and then he started doing this advanced analysis. So, Dow theory is covered in the next chapter. We will cover it into more details. But for the Western world, the technical analysis or the charting has originated from the works of Charles Dow. But for the Eastern world, Japanese have been using technical analysis like way more before Charles Dow actually used it. So, technical analysis can be used across assets. It can be used on bonds, commodities, currencies, everywhere, and across multiple time frames. So, now the best thing about technical analysis is that it can accommodate every type of trader. It can accommodate a scalper who wants to trade within a time frame for 1 minute to 5 minutes. It can accommodate a intraday trader who wants to trade on a 5-minute time frame. He can accommodate a swing trader who wants to trade on an early time frame. He can accommodate a positional trader who wants to trade on daily time frame. It can accommodate a larger time frame trader, an investor type of trader who wants to trade on the weekly and the monthly charts. Even it can accommodate supercomputers nowadays who wants to trade on tick databases, who want to trade on nanoseconds. So, every type of trader, every type of trading is accommodated. So, but when we talk about fundamental analysis, right, it's not like that. Fundamental analysis is buying and sitting and waiting for the story to evolve, for the results to come in. But it's not about technical analysis, is different thing altogether. That's why the scope is wider. Okay. So, how we study technical analysis? We study technical analysis using charts, indicators, volumes, sentiments, cycles, relative strength. So, these are some things that these are very, very important things that we have to use while we are using and we are trying to learn to take. Now, when you will go out into the social media world, now you will be more, you will see that people are more concerned about charts, indicators and volumes. These are the things which 99.99% traders are using. And these are something: sentiment, cycle, relative strength, and then there is intermarket analysis, then there is intramarket analysis. These are called situational awareness. And these are the things that only probably 0.01% traders are using. And how many traders are successfully making money and how many traders are losing money? So, this is the thing. It is a very, very wide subject. It's a very, very bigger subject than perceived, right? So, this is a very, very important thing that you have to understand, that technical analysis is not just about candlesticks or volumes. It is a very, very wide subject, very, very big subject. So, when we are covering the curriculum will talk about everything in details. So, charting, basically charts are the core subject, or the charts are the core tools that we will use, because without a chart, a technician is nothing. You cannot do anything without a chart. So, a charting software has to be there with you, right? So, to understand how technical analysis works. So, what is the difference between fundamental analysis and technical analysis? Now, this is a very interesting subject, and I have talked about this many times, right? So, when we are talking about fundamental analysis, right, let us discuss what fundamental analysis is all about. Most of you will say, sir, PL, right, balance sheet, okay. Some will be say cash flow, fund flow. Some will be say like the managerial interviews, right? Some will say competitor analysis, right? And there are many things. When we talk about technical analysis, we will talk about price, we'll talk about volume, we'll talk about open interest, and blah 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 blah. Now, if I tell you what fundamental analysis is all about, you will of course answer me. It's the study of the cash flow, the fund flow, the PL, the competitor analysis. Now, what about the dollar price? What about the imports and exports policies? What about the tariffs that we have just seen? What about wars? What about policies of the governments? What about stable and unstable governments? What about the crude price? What about the commodity prices? What about recession? What about inflation? So, this thing that you call fundamental analysis is not fundamental analysis, this is financial analysis. And when we talk about this plus this, then it becomes fundamental analysis, right? What sector is moving? So, now, being an individual, is it possible for you to track so many things? No, it's not possible. Obviously, it's not possible. And even if you can track so many things, your scope will be very small. Either you are busy in tracking the IT, either you are busy in tracking the oil, either you are busy in tracking the auto, right? But the end result of all these things will be reflected in price and volumes. So, if we can read price, volume, sentiment, market breadth, intermarket analysis, these properly, we are doing a backdoor study of financial analysis or fundamental analysis, right? So, when you read technical analysis properly, when you read technical analysis in the real definition of technical analysis, then you are doing a whole 360-degree analysis of everything. You don't need to know why the crude price has shot up, but you need to know that if the crude price is shot up, what will be the effect on other asset class. So, this is technical analysis. This is the broader view of technical analysis. This is how things work. And when you become a chartered holder, you have, and when you onboard clients, just telling them that this is the shooting star, this is the engulfing pattern, buy above it, keep stop loss below it, it won't work, sir. Right? So, key assumptions of technical analysis, we have already discussed more of them, that price will discount everything, right? Price will move in trends. One of the most important assumption that if the price has started moving, it will move in trends. So, if it doesn't move in trend, if the move is random, then technical analysis are out of the work, right? Then we cannot work, because we need trend to trade. So, the prices will move in trend once established, and then it will persist. Once the trend is established, it is expected to persist. We will cover this in great detail in the coming chapters. And history will repeat itself. We have already discussed it, but the reasons will be different, but the patterns will be same, right? And then it is a very important thing that technical analysis is probabilistic, not predictive. And now, the earlier you realize this thing and the earlier you accept this thing, the better it will be. Because when we are talking about technical analysis, we are talking about the probability of a event or probability of a price. It's not about predictive. We must always use the word it may break out from here, it may break down from here. We shouldn't use that it will break down or it will break out. Now, many a times we have seen that we talk about targets. Now, when we are talking about targets, we are again predicting. No, we shouldn't predict a price. We should follow the price. And when you apply this approach to follow the price, right? If the price has broken out of a pattern, suppose this is a cup and handle pattern, the price has broken out of the pattern, okay, well and good. Now what you have to do, you have to follow the price. You have to keep a track on this price. You just cannot say that now it has broken out and it will touch 700, right? It has broken out at 350, now it will touch 700. No, it's not like that. You have to follow the trend. You have to follow the price. You shouldn't be there to predict that Nifty will touch 20,000, Nifty will touch 80,000. When, bhai? So, predictive analysis, if you are into predictive analysis, you are just wasting your time. I am talking about practicality. I am not talking about academics, because I know that this practical application is going to help you if you go ahead and start using technical analysis. Now, there are type of charts: line charts, bar charts, candlestick charts, point and figure charts. Now, what type of chart you want to use, it totally depends on your perspective and on your objective. Now, let us come to this. So, this is a candlestick chart, right? And this is a line chart where we are only dealing with the close price. When we are dealing with a candlestick chart, we are dealing with the open, high, low and close, and the candlestick tells us many things other than open, high, low and close. Now, there is another type of chart which is the bar chart, right? Now, there are other type of charts which are called the Heiken-Ashi chart. We have 3-line break charts, and then again we will have some sort of charts that are called point and figure charts, right? These are point and figure charts. We will cover everything, don't worry. But what type of chart pattern you have to use, what are the type of chart pattern that you feel, suits you, is totally dependent on your type of analysis that you do, on the type of comfort level that you have with the charts. Well, if you ask me, I would really like to use the raw charts. Raw charts means the proper candlestick open, high, low and close chart. I don't want to tweak the charts. I don't want to use point and figure. I don't want to use the Heiken-Ashi charts. I want to use them raw. I want to see what the price is telling me at this point. I don't want to modify it, right? So, again, it is your objective. It is your comfort level, what you feel comfortable with. We will discuss everything, of course. Now, what does a trend show and what is a trend? So, basically, when we are talking about trend, trends are basically price moving. So, when the prices are creating higher tops and higher bottoms, it's an uptrend. When a price is creating a lower top and a lower bottom, it's a downtrend, right? And when a price is going nowhere, it's called a sideways trend. So, trend will show us a direction, trend will show us the momentum. So, when we are talking about uptrend, you can see the uptrend here. When we are talking about uptrend, what do we see? We see that the price is advancing up, the price is creating higher tops, the price is creating higher bottoms. So, this is an uptrend, and while looking at this trend, while looking at this pattern of higher highs and higher bottoms, we can presume that the trend is going to continue up. It tells us that this trend is up. Similarly, when we are looking at a pattern that is creating lower tops and lower bottoms, we can say that the trend is down. The trend is supposed to go down. And when we see that there are almost equal tops and equal bottom, we can assume that the trend is going nowhere, right? So, we have uptrend when the prices are creating higher tops and higher bottom. We have downtrend when the prices are creating lower tops and lower bottoms. We have sideways ranges where the trend is doing nothing. And how we can, and there are many tools which can help us in visualizing the trends, right? You can use trend lines. We'll cover everything. I'm just giving you an overview of the first chapter. We can use channels, right? We can use moving averages. There are many tools that can be used to determine trends. Now, next is Dow theory. Now, this is just an introduction of Dow theory. Dow theory is covered in a lot of detail in the next chapter. So, what is Dow theory? Dow theory basically tells us the core of technical analysis. Now, my friend, there is a very big problem with this theory. Not with this theory, but with the use of this theory. People are using this theory in a very incorrect way. And I can tell you one thing. With my 20 years of experience in the stock market, in trading, that if you can understand this theory properly, if you can understand the core of this theory, there are 6 tenets in this theory, and if you can understand these 6 tenets properly, then believe me, my friend, 90% of your job is done. You don't need any other tool for your rest of your life to trade profitably at least. But the human nature is so that we don't want easy things. We want to complicate things, right? So Dow theory is a very, very important theory. It is the core, it is the base of technical analysis. So when you are building a big structure, you need a strong base, and that's why Dow theory is a very, very strong a subject that will provide you a very, very strong base. Now it tells you that the market moves in different phases, right? It tells you that there is an accumulation phase where the price is into a sideways zone, where smart money, where the big money is accumulating. There is an uptrend. This is an uptrend where we say that the prices are now into a participation mode, that everyone is participating in this uptrend. People are buying, public is buying, general public is buying, the smart money is buying. Then there is a phase that is called the distribution phase, where these smart money who have bought, now they are trying to sell. The change of hands are taking place, and then there is the fourth phase that is called the markdown phase, which is the downtrend. So there are 4 phases of the market, right? So we will cover this into a great detail, great depth as we go forward, but this is just an introduction that the chapter 1 of the CMT curriculum provides. So this is Dow theory, right? Next is support and resistance. Now what is support and resistance? Level where buying is expected. Now let us come to the charts directly, and let me show you how the support and resistance works. So if I say that the price is approaching a support, right? Now this is a support zone. How this support zone is calculated, what is the logic behind this support zone, we will cover it, right? But right now we have to stay focused on our curriculum, what the first chapter of CMT curriculum is telling us that we are supposed to know. We are only discussing that, right? So this is a support. A support is the level where some buying is expected. Now when the prices are approaching at this support level, what we saw that some buying is expected, and because of this buying, the prices were pushed up, right? What is a resistance level? A resistance level is a level where if the prices reaches, then some selling is expected. Now this is the resistance level. At this point previously selling was selling took place, prices came back again. At this point some selling took place. Now the price is testing this point again, and now what we expect, we expect this point to act as a resistance where selling is taking place, and we saw that from this point the selling took place. So what is resistance? Resistance is a zone where selling pressure is existing. Now what will happen? This resistance can be broken, of course. If the resistance doesn't break, then the price will always be moving down. For the price to move up, it needs to break this resistance, and when the resistance is broken, now it turns into support. It will turn into support now let me give you one example. Now suppose this is a very good example, right? This was a zone from where supply emerged, prices went down from this zone, and then again when the prices came back to this zone, there was a deliberation of the price, it moved down. Now what we can say, that this was a resistance zone, or rather look at this point. This was a resistance zone, right? Price came to this point and there was a sell off that took place. Now again when the price went up, it broke this resistance point, and now this resistance turned into the support. Now this is called a broken resistance becomes support, and a broken support becomes resistance. SR flip. We'll cover these things very, very in very, very detailed manner as we move forward. So as I told you, horizontal zones. Now what is zones? When we talk about support and resistance lines, if we draw lines and if we draw zones, now where do you feel comfortable, in the lines or in the zones? So the zones are like more reliable than the exact. So whenever you start taking consultations or you start doing analysis with your clients, Never tell them that Nifty is going to touch 18,000. No, it's not like that. You have to tell them that the support zone of Nifty is somewhere between 7,800 to 18,000. The resistance zone is somewhere between 19,000 to 19,200, because every time there will be a zone. Exact levels won't work, never work, right? So again, this is support resistance that you have to understand. Then there is a volume analysis. Now what is volume? Volume will generally confirm the strength of the price, whether the price move that has taken place is a really genuine move. And if there is a divergence between price and volume, then we can say that yes, the price move is not that genuine. Now let me show you. Look at this phase, right? When the prices are moving down, do you see that the volumes are also moving up? That means there is a real selling pressure. The prices are moving down, the volumes are moving up, real selling pressure. When the prices are moving up, now can you see this part? The trend, overall trend was down. Now just focus on this part. What do you see? The price did went up, but do you see any type of spark that that appeared on the volume? No, the volume was flat. In fact, the volume was falling. What does this mean? That this push up was not followed by strong volumes. Means that this move up was just a pullback move. This was not a move that could have changed the trend. But look at this zone. Look at the red bars and look at the volumes that we had on red bars. What does this volume analysis and price analysis tells us? This tells us that there is a strong participation in the selling. This analysis is called VPA analysis, that is the volume price analysis, and this is the core of technical analysis. This is the core of technical analysis, price action radar. Now if you don't know this thing, then you will probably not be able to analyze the market properly, right? So it is very, very important, and this is covered very, very extensively in Dow theory. When we will cover Dow theory, we will cover this very, very extensively. Then we have indicators and oscillators, right? Now this is welcome to the indicator world, right? Everybody is fascinated about indicators, right? Sir, tell me how MACD works. Sir, tell me how RSI works. Stochastic kaise kaam karta hai? Sir, tell me about indicators. Well, the truth is this, that indicators are just waste of time, because 99% of you don't know how to use the indicator correctly. Indicators are never used for buy or sell. Please note this. Indicators are just analysis and confirmation tool. It is not an buy and sell tool. Now when you are driving a car, right, you give an indicator. You give an indication that you are going to turn right. But until and unless you commit to the right side, your indication doesn't make sense. If I am driving behind you and you give an indicator to me that I am going to turn right, until and unless I see you committing on the right side, I'm not gonna cut you from the left or cut you from the right. I'll be just following you. And when I saw that yes, the indicator, you have given me a right turn indicator, now you're committing yourself to the right, then only I will be satisfied that yes, this indicator, he has given the right side indicator and he is now committing to the right side. This is same thing that happens in technical analysis, and that's why it is called an indicator. It's not called a confirmation tool. So we have a lot of indicator. Now if we come to this indicator window, and you will see, oh my god, right? You will be like bombed with indicators, so many indicators, volumes, momentum, stochastics, right, what not. So be very, very careful when you use your indicators, and choose your indicators very, very carefully, right? So the most popular ones are of course RSI, MACD, stochastics, right, moving averages, Bollinger Bands, they are all indicators. So whatever is covered in the curriculum, we will of course cover that in the curriculum. But when you're trading into real life, when you're trading in the real market scenario, you don't need so many indicators. One indicator is enough. And if you focus on price properly, if you focus on the market breadth, if you focus on Dow theory, you will not require even a single indicator also, right? So when we talk about now, as I told you, and as we have discussed, that there are different time frames. You can use a 5-minute time frame. You can use a 15-minute time frame. You can use a 30-minute time frame. There are different time frames for short-term and long-term analysis. So if you are a short-term trader, you can use shorter term charts. If you are a longer term trader, you can use the daily, weekly and monthlies. If you are a very short term trader, you can use 5 minutes, 10 minutes and 15 minutes. And if you are a medium term trader, you can use hourly and daily charts. Now, there are two type of scales. First is the arithmetic scale, that is the normal scale, right? This, what you see on the chart here, is an arithmetic scale. And this is when we are reading the price, that is within a measurable limit, right? When the price hasn't moved up like 1000% or more than that in a very shorter time, then we use the arithmetic scale. But at sometimes we will see that there are many times where the price moved very, very fast in a very small span of time. So if you remember a stock, that is Talna platform, right? Now just look at this point, right? From the year 2020, right? This is just during the COVID times. It started around 47 and it reached around 21 in just a matter of 2 years. Now, if you want to analyze this type of move, right, then in this case, using an arithmetic chart is not a good choice. What we can do, we can use a percentage basis move. How much the stock has moved into a percentage basis, right? We can use those charts. So, if you start using an arithmetic chart, it will be very, very difficult to analyze it. So, what we do, we just go and we can use a log chart, and with the log chart, the price moves are now converted into a percentage basis, right? And our analysis becomes little bit easier on it. So, that we will cover as we move forward. Just an introduction how we have to. So, there are two type of chart. First is the logarithmic chart and then is the arithmetic chart. Now, very, very important subject, that is the fractal. Now, what are fractals? Fractals means that, and this is also one of the most important core of technical analysis, right? Fractal will generally mean the price patterns that we see appear on every time frame. So, suppose when we are analyzing a flag pattern, so this is the strong breakout and there is a flag pattern formation and then there is a breakout of the flag. Now, this flag we are analyzing it on the daily chart. Now, when we switch on to the hourly chart, there will be cases where we can even analyze the flags on the hourly charts as well, right? Now, let me again come to the Nifty chart. And now we have now you can see this is the hourly chart and we can see that there is a flag pattern here on the hourly chart as well. Now, let me come to the 15 minutes chart. Now, on the 15 minutes chart, we can also analyze again the flag pattern is there, right? So, the patterns are repetitive, number one, and of course, the same pattern appears on every time frame. So, this is fractal. So, when fractal is also a very, very important core part of technical analysis, right? So, when we are talking about moving average crossovers, when we are talking about triangles, when we are talking about head and shoulders, all the patterns of technical analysis, they appear on every time frame, and the probability of their behavior is almost same on every time frame. So, this is what is fractals. Now, you can see that markets exhibit fractal properties. That means pattern repeats at various scales. Alright. So, again, this is an assumption of history repeats itself. That means these patterns will keep on repeating on different time frames and they will have the same probability. It may appear on the daily chart as well as it may appear on the weekly chart, on the monthly chart, and these are similar patterns because they reflect the same human behavior on different charts. Now, what does this mean? Same human behavior on different charts. Suppose you are trading on the monthly chart, so you will behave in the same way on the monthly chart. I am trading on the daily chart. My behavior will be about that pattern will be same on the daily chart, right? Now, when we are using fractals, like when we will discuss the Elliott wave theory, we will go more into the fractals because the Elliott wave theory is based on this fractal theory and not even Elliott wave theories. Even when you do your analysis, we do multiple time frame analysis, right? We look at weekly charts, we look at daily charts, we look at hourly charts, and then probably we come out with our analysis. So, when we are doing multiple time frame analysis, what we are doing actually? We are using fractals. We are trying to analyze the chart on different time frames. We are trying to get the confirmation whether the trend on the different time frames is same or not, right? And then Fractal helps us to align short term and long term charts. So technical analysis refers to collective investor behavior. It shows us emotions like fear and greed. Patterns repeat due to behavioral biases, and it is aligned with the financial concepts. So there are some criticism and misconceptions about technical analysis. Somebody will say it is subjective because you use subjective tools. Don't use subjective tools, it won't be subjective, right? Some will say it is a self-fulfilling prophecy. In the same charts, I can be bullish. On the same chart, I can be bearish. If I see a bullish pattern, you can argue with me, sir, that this is not a bullish pattern, this is the bearish pattern, right? What you see, this is called basically self-fulfilling prophecy. What you want to see, the chart shows you, right? But again, it is due to the subjective nature. Now, if you stop using subjective tools, then this will also be eliminated. Now, technical analysis helps us in proper clear process building, risk management, thinking in probabilities, and of course keeping ourselves very, very disciplined. So this is the first chapter which tells us about technical analysis. Now what you can do, we have prepared 50 questions, multiple type of questions that we have shared. You will get the link in the description. You can go there and you can download those question sets and you can practice them. Plus tell us how do you like this session, right? Whether it is useful for you, whether we should continue this, whether we should improve this. Give us tips to improve this session, right? We will of course try to bring in more clarity. We try to bring in more details into this session. But for this, I think that we are trying our best to bring you the best thing, and I hope that our sessions will be very, very useful for you to keep your preparation up, right? You will not require that extra pressure to prepare for CMT. So with that, I end my session here. I hope you liked it. Do subscribe it and do share it with your fellow learners also. Keep earning, keep learning, keep sharing.